We ready? Good morning and welcome back to the Opportunistic Trader at 10 o'clock on a sleepy Thursday, pretty much. I'm joined by my friend and a respected analyst across Wall Street, Phil Flynn. I've known for many, many years. And Phil, thank you for joining me this morning. And we'll
Thank
talk.
you.
I'm going to let you lead me to whatever markets are interesting. My market, which is S&P, is rallied but kind of slow. But I wanted to hear from you and your thoughts on all markets.
Well, I know you are the master of the swing trade and the day trade, Larry, and and I get a sense like big picture. Sometimes you don't care just as long as it moves, and I agree with you. I think one of the things I'm saying with the stock market is to embrace the volatility. You know, a lot of traders, of course, have been waiting for volatility for the last few years, and now that it's here, you have to kind of change your trading style a little bit to be more aggressive in taking profits, more aggressive to catching the big swings. Even though I think in the big picture, I think that this, from a position standpoint, I think this is one of the best buying opportunities in stocks we've had in many years. And my belief is because I believe that the steps that's going to be taken by the Federal Reserve, by the record amount of stimulus from China that we've seen in the last week, as well as a more dovish Mario Draghi, is going to create the environment that should put in a put for the market long term. And we're just at the start of earnings season here, and I think the earnings are not going to be that bad. In fact, they might even exceed expectations, and it could provide a good long-term buying opportunity for stocks. Maybe in memory of the late great Mr. Bogle, who just passed away, the index fund guy, who created, of course, the first index fund that basically didn't try to beat the market, just went with the market. That might be a good time to put on those type of strategies, because I'm a big believer that the U.S. stock market's going to have a really good year this year. And I think a lot of the pessimism we've seen big picture has been really overplayed.
I agree with you. My only thought on this is if we had you on 12 trading days ago, the mantra for what I do, which is sort of the name of the site, opportunistic type stuff. For me, we've had a rally in many of these stocks, 20 to 40% off the lows, and broad index is probably about 12 to 13% on the S&P off the low, and NASDAQ's about 15, 17 off the low. And to me, I'm not saying I don't like the market. I'm just concerned that the sentiment has changed so quickly over 13 trading days that even Jim Cramer said the day before Christmas this was the worst market that he could ever remember, which is...
And that was the bottom, right? That was the bottom. Thank you, Jim. Your timing's impeccable. I like the market per se, but overall I think there's work to do. But I think the interesting takeaway, and I don't know what your thought is on this and whether or not this will hold up, is looking at volatility. So as a trader such as myself, over the last 8 years, taking out last year, volatility was between 9 and, on the high end, 12, 13. We had a couple of bumps, that lasted less than a couple of weeks over that period of time. And my question or thought to you is, and you discussed it originally when we started talking, is maybe the new normal in here is 2019. So people have to adjust their mindset into what a move is. So on a 20 volatility, 1% to 1.5% move per day intraday is not unheard of, whereas on an 11 vol, we're looking at a 50 basis point move. So I think, like you said, people have to adjust to what I consider, and again, the new normal. Now, you may have a different insight into where. I'm just curious to think what your thoughts are on volatility, and if in fact we do have a bull run here or a run higher, like you're thinking, how volatility could sustain at 20. Wouldn't it have to come in? So I just want to know your thoughts on, volatility at these levels.
I think you're absolutely right. I think that you're going to be looking at these moves, with, from a different landscape. Where before on the S&P, if you had a 10-cent, break or a 10-cent rally, you'd be buying and selling it with an upward bias in the market. Now you probably have to triple that or quadruple that on a daily basis, for that buy and sell, but still with that upward bias over the long term. So I think you're absolutely right. And your point that the market looked the worst on Christmas, it does look to me like that big major sell-off on Christmas was like a capitulation bottom to me. And that was kind of the final throes of all the panic. And as we look forward, I think it is, but I think you're absolutely right. I think that it's not going to be, unless you're like in a fund and you don't look at it, it's not going to be, just a straight up shot like we saw for the last 2 years. You're going to see some peaks and valleys along the way. And you did point out how quickly the sentiment turned around from bearish to bullish on December. But, on the flip side of that, the sentiment really turned around because people forget, that when we were into the stock market, we were at a record high in August, and so from August down, to the end of the year, we plummeted with extreme volatility. So I guess, the move that we saw on the downside, we saw with high volatility to get to those, the most terrible market. Now that the sentiment has changed, maybe we can see that same kind of volatility, but instead of, the market crashing, eventually, adding to the gains and recovery that we have seen. Now, admittedly, we may consolidate here for a little bit because there's a lot of questions out there in the marketplace. But I think ultimately the bullish catalyst that I see in the market is, the tax cuts from the Trump administration, I think are still going to have a long-lasting impact on global economic growth and U.S. economic growth. I think we're a lot closer to a trade deal with China. And now that global central banks are, putting in a backstop, you don't want to fight the Fed. If the Fed's telling you, hey, we're going to put in a put, you don't want to fight the Fed. You don't want to fight the Chinese central bank when they added $1 trillion of liquidity to the market, in a week. That's kind of telling you that they're not going to let things fall too far out of here. And then when you got Mr. Do whatever it takes, Mario Draghi, basically saying, hey, you know what? Maybe we were, we're gonna, we were too hawkish, and assuring the market that they've got the markets back. So now you've got a central banks around the globe, which back in August were saying, hey, we're going to start raising rates. We got to be more aggressive, to ward off inflation. Are now going to be a lot more measured, and if not measured, they might even go the other way and be a lot more accommodative. It's always the perfect mix for a bullish stock market. We have yet to seen ever in the history of the world when every major central bank, and again, especially even the financial crisis, when they're all pumping in liquidity at the same time, the markets really have no choice but to eventually go higher.
Yeah, we've seen that over a number of years. One question or comment, do you think that the government shutdown is going to have an impact? What impact do you think it'll have? And do you think at some point, I don't know if I think we're day 25 or whatever day it is, at what time does it really have an impact? Because the real takeaway that I have is I was out to dinner last night, and someone that I know from the business, and they do a lot of syndicate or IPO product, and they're involved with a hedge fund, and they do a lot of volume and stuff like that. And he said he walked over to me last night in the restaurant. He goes, "I'm out of business." I go, what do you mean you're out of business? He goes, the SEC is closed down and there is no initial public offerings being offered, during the shutdown. So literally for 1 month, there has been zero activity in the pipeline as far as bringing, liquidity or new stock to market. And my takeaway is that's got to not be that bullish. And then running into people, and interestingly enough, Mike, who works with us here at the Opportunistic Trader, his brother's involved, with some government contracts or whatever, and he's not getting paid. So at some point, I was just wondering your thought on that, and if it does have an impact, and what you think that'll be on growth, and what do you think it'll have at some point on the stock market, if at all?
Right. I think the Trump administration basically raised their forecast of its impact on global economic growth. I know in the energy sector, it was kind of the same thing. There was a concern that, that we wouldn't get approvals for drilling and stuff. But the Trump administration said, hey, they're essential. So they're getting waivers on the energy front. But you're right. When it comes to some of the IPOs, it could slow down. The impact, what they were saying, a tenth off GDP for every month that there's a shutdown. Was that the number from the Trump administration?
I think that sounds about right.
But about right.
So it's funny. Yeah. I'm sorry to interrupt you, but it's funny to me. You're talking about $5 billion on the max. Okay, this is costing 10 times that all day long, and it's really just a political infight. Because whether it's 3 billion, 5 billion, 2 billion, it's just it's an odd lot on the balance sheet, right?
It is. I mean, listen, if this goes on for many months, there's no doubt it's going to take a little bit of a toll. From the flip side, though, it's going to create pent-up demand that when they finally lift this thing, you'll get a surge of economic activity because it's not real. This is an artificial shutdown. It's an artificial slowdown. So if a company wants to go public, you're just going to get a backlog and a lot of IPOs coming out, hopefully very quickly, as fast as the SEC can move, which isn't very fast. But you're going to probably get pent-up demand if it goes on for an extended period of time. So what you lose on the front end, you're going to probably get back, on the back end, and having said that, yeah, absolutely. This is not about reality. It's about politics. And, I've studied a little bit about some of the other government shutdowns. Just about all of them had minimal impact on the economy overall, over a period of time. Now, admittedly, this one's getting to be the longest one in history. And if it continues forever, obviously it's going to have an impact. But we all know it's not going to continue forever. At some point, somebody's going to have to give in. And you're right. It's over a very silly issue, and it's all about politics. And it really comes down to, I like Donald Trump, I don't like Donald Trump, because everybody says, as far as the wall goes, it's like, hey, most of the people that are fighting the wall tooth and nail were for the wall before they were against the wall, right? And Nancy Pelosi was for a wall before she was against it. Chuck Schumer was for a wall before they were against it. So they were all on for the wall, in previous speeches, but now because it's Donald Trump's wall, they're all against it. So that's really what it comes down to. It's basically a political football. And they're going to be looking at the poll numbers to see who's going to have to give in at some point. But it just shows you that, we're polarized. It's not about facts. I go back to the Keystone Pipeline. Keystone Pipeline, same situation. Everybody that looked at that pipeline knew that they weren't shutting it down for environmental reasons, that it had no risk to the aquifer, which was the original reason that the Obama administration dragged their feet on approving this for years, because it really had to do with Canadian, that the environmentalists didn't like Canadian oil sands oil. That's what it was really about. But they didn't want to admit that in the beginning until 8 years later, when they said that was the reason they had delayed the pipeline. But from a realistic viewpoint, from an environmental fight, it actually made the environment less safe. We had train disasters because they were carrying all this heavy oil. We had spills of oil that you wouldn't have had if you had a pipeline in play. And so it actually did more damage to the environment while they were fighting over this pipeline, whether they would have approved it in the first place. So it just shows you that when it comes to politics, common sense, takes a back seat, to reality. $5 million, to do this war, or billion. They've spent more than that on the government shutdown. But the government doesn't care because they love to spend your money. They don't care.
I know it's
politics be damned. It's they love to spend your money. So it's not about that. It's not about common sense.
It's an unbelievable position, but for me, it's funny when we have the shutdown. The market rallied the whole time the shutdown, literally.
Right.
And then when we get back to work, it's going to rally because we got back to work. So it's a double positive. Yeah. So
I think the bigger picture. Listen, we're going to go headline to headline. I to be honest with you, I think the government shutdown is behind China, the China trade deal. I think that's where the market, what they really, really care about. They realize at some point the government's going to reopen. And it'll probably, like I say, the short-term impact on GDP will be made up on the back end. So, so I'm not too worried about that. But it makes for great theater.
Sure. Without a doubt. Well, talking about the China trade deal, I don't know exactly. I think it's Hawaii, the phone maker, and ZTE, the United States is going after those guys. I mean, if we're really close to a trade deal, wouldn't they just bypass that and then in the trade deal address it and let these guys sort of in a way get a pass rather than go after them? And that's the one thing that I don't understand, that like we're pressing them every single day and we're supposedly making an amazing deal with them, but yet we're pressing them every day as if they were stealing from us, which they may, but don't they have to let that pass to do a deal?
Yeah, I think with the Huawei situation, there is two things there. On one hand, I would agree with you. You would think, call off the dogs a little bit to get a deal done. Where Trump is a high pressure guy, let's keep the pressure on until they come to the table. But the Huawei situation is a little bit different because there are some concerns that it goes beyond trade and goes into national security. And there's a concern that the technology that they have on these Huawei phones can actually steal, U.S. technology and actually secrets. And this is not just about, intellectual property. This is about the protection, of the overall system. Of safety. I don't know how many people, I bought a computer at Best Buy and they say, here, free virus software, Kaspersky was the name of it. And so sure enough, like me, like every other, free virus software, bought a new computer, put it on there. Come to find out in the past, that was a Russian company and the Russian company was stealing data. Now, you don't hear a lot about this, right? They were stealing data off everybody's computer, okay? Now, that might not sound like a big deal. And I'm a big believer that because I'm on the internet, everybody who wants to knows everything they want about me anyway, because hackers have already hacked me, right? So, but from a national security point, you don't hear a lot about that a major company like Best Buy was using, Russian software, and the Russian government was getting information about U.S. citizens off their software. You don't hear a lot about that. Another story about Best Buy, just as long as we're down that, Best Buy apparently had some other software where the U.S. government, of course, was using that for terrorist activities. I forget the name of that software, but they were sharing data. So on the Geek Squad. So if you use the Geek Squad, the government knows everything about you.
It's amazing. I wanted to just shift away and get your thoughts. I know we're having great conversation, and I don't know how long I have you for. So I wanted to get your thoughts on other markets. I know you're very involved in oil and the metals and, also some esoteric markets that are important. And I wanted to know what your thoughts are on those markets and give our viewers some insight into, what you're looking at and what you think your best setups are and all of that.
Yeah, listen, long term, I think oil right now is kind of in a trading range right now. I think the preponderance of the fundamentals are going to prove to be very bullish in a few months. We got a report today about OPEC compliance. They are over complying with cuts in December, and they're going to really comply in January. We saw a crude oil drawdown this week. That's going to be the first of many. So the supplies are going to tighten up. I know a lot of people are worried about the build in gasoline and distillate. Refiners may have pulled back because of that. But I think that's going to continue to weigh on sentiment a little bit in the short term. But I think at the end of the day, when you start seeing the oil inventories in the U.S. start to drop, that at some point is going to create a really good catalyst for this market to go higher. I know a lot of people were very excited that we hit a new record on U.S. production. It surged last week, and that's good. But what we're hearing from the people in the shale patches, you're going to see a pullback because a lot of the rig guys, because of the price drop, are not going to be adding rigs. So some of those production increases may moderate a little bit. Yes, we're going to see new pipelines later in the year that can bring more production on. But I think, going into the April rally ahead of the unleaded gasoline season, people are going to be complacent because they think we have a lot of gas. The problem is we don't have a lot of summertime blended gasoline. So all that supply that we see in the numbers are going to have to be, drawn down, and they're going to have to replace it with summertime blends of gasoline. That could mean some less gasoline production, but I think overall our base case for oil is higher. But the one that's going to the sky and catching a lot of attention is palladium, which hit another record high overnight. And a really interesting story here. I mean, part of this goes back to the diesel scandal in Europe, Dieselgate. Remember when Volkswagen was lying to everybody about the emissions on the diesel cars? This is causing a lot of people in Europe to, move to gasoline-powered cars, causing some people to ban diesel cars. So you're going to have to replace a lot of cars. You're going to have to use very strong catalytic converters. It's going to use a lot of palladium, and we're going to have a shortage. So I think that's weighing on the market right now. I think if you look at the grain markets, kind of boring, in a range, waiting for some weather, waiting for a trade deal, nothing to do. Soft's kind of in a range. We had a big run up on cocoa, big run down on cocoa. So a lot of choppy trading, for those markets. I just think, we're going to buy the break, sell the rally mode for right now until we get some new news.
Okay. Any thought on bonds or interest rates in general?
Right now we know the Fed is going to be less aggressive raising interest rates. Even the biggest hawk, Esther George, basically now is a dove. So for the bonds, I'm just playing the ranges on bonds, not taking a long-term position, because even, when we know what the Fed is probably going to do or not going to do, we're not getting any strong trends. What are you thinking on the bonds yourself?
I have an interesting thought, and this is just my thought. I think that the curve, if we have a sell-off at some point, which, we're going to have bumpy markets, but if we have a 5% sell-off type of thing, I think you're going to see yield curve inversion 2s to 10s. Okay, there's some in the middle of the curve here, but I think you're going to see a 2 to 10 inversion. I think that could play this year. But overall, I think that, it'll be more of the same of yield curve flattening. The curve is probably fairly priced here, basis everything, and the mantra of much higher rates is off the table. That was on the table about 3 months ago. But now, since the shift, the Fed isn't going to touch rates. So basically, they're going to come to buy the longer dated maturities, and it could cause an inversion. That's just my thought. I think you might see that.
Great thought. I think that's a great thought.
So I think you play the yield curve flattening and look for an inversion into a weaker S&P, because even in this rally up in the S&P, the yield curve still has been flattening. So that trade is intact. And, overall, I'm sort of in your camp. I do think you're going to see a little bit more bumps in the S&P here. I don't think it's a straight shot. I think, this is beginning year allocations. Now people are behind the market by 3 or 4% after freaking out at the end of the year. I think a lot of the end of the year was hedge funds facing redemptions, and most of hedge funds were waiting till late in the year. So if you have $6 billion under management and you get redeemed $2 billion, you still are in December using the $6 billion. Or the 8 billion, and then you got to get down to 6. So there was a lot of selling and a lot of illiquidity, and those are that's my thought. But I'm happy that you joined me.
Thank you, Rob. I was happy to be here. It's good to be on with you, and it's very exciting, and I really enjoyed the conversation.
Yeah, me too, Phil. Thank you very much, and I appreciate it. Have a great day.
You too.